Welcome to This Week in Money. I'm Jim Goddard. Happy Canadian Thanksgiving and happy Columbus and Indigenous Peoples Day in the U.S. Today, Ross Clark from Park.Stock runs down the major markets that exhibited seasonality plays. He checks out the U.S. dollar, gold, crude, uranium, and the Russell 3000. President of Venable Park Investment Council Incorporated, Danielle Park, digs into the state of the stock markets and the sectors she likes right now. She comments on interest rates, real estate, and auto sales. Publisher of the VR newsletters, Mark Leibovit, comments on how the U.S. Fed is mishandling the economy, the war on cash, the possible American federal legalization of pot, and how the markets are being manipulated. He also has a special offer for our listeners. Plus, at the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to our Canadian Thanksgiving, American Columbus Day, and U.S. Indigenous Peoples Day show.
Isn't that a mouthful? So, those of us who are involved in the markets will find a way to participate on Monday, and then again when we get out to the U.S. Thanksgiving somewhere in November. So this is a period of usually of pretty good opportunity as we come into this holiday weekend. We're into the basing phase on the seasonality for the equity markets. The August-September window is usually one, the latter part of the chop to the downside. And as you go into October, you look for the basis to happen. And this week, we're starting to see some pretty good indications. The sentiment numbers became very negative, which is what you would expect. We've got double and triple bottoms on some of the indices, looking at them on the daily basis, that being, say, the Dow and the S&P. Then you got the NASDAQ, in particular with the Magnificent Seven, which have held a big part of the gains from the early part of the year, holding at their 20-week moving averages on that index, the FANG index of these Magnificent Seven, and some real life towards the end of the week. So looks as though seasonally we've got a very important flow now in place. What you want to watch for are the stocks that are showing the best resiliency coming out of this low. Take a look at some of the stocks in the cyber area in terms of cybersecurity. We won't talk about individual names, but the HACK index is looking very good. Nice base there over the last year or so, and it really looks as though it's got some life in it right now.
An index that we don't usually look at, the Russell 3000, how's it doing?
Well, you got the Russell 1, 2, and 3000s, and each one of them's got a little different makeup to them. The Russell 3000 has had not a bad year this year. He had been up and came within 10% of the all-time highs during the spring. Sold off, and if anything, has been a little bit weaker than, say, the NASDAQ and the S&P but looks as though it might be putting in a little bit of a base here. The big one to look at, though, is the Russell 2000. And that one, if we take a look at the weekly chart, it has been playing against the lows of the last 2 years. It's been down 3 or 4 times now, testing the support. Just has not had any buoyancy at all. But the key here is that we've got an oversold reading. We've only got about half a dozen of these since the 1980s that are like the one that's in there right now with one of our sequential signals. And the likelihood here of a really good bounce in the weakest of the group it looks to be quite promising. So if we can have strength in the weak ones, think of what the strong ones will end up doing here. So we sent that out to clients, and I'm going to post it up on our website just as a picture there so you can see that there's a very good likelihood that in this seasonal period where you expect some strength in the good ones, even the worst of these will probably see a good 10 or 15% rally.
What's going on with the U.S. and Canadian dollars?
Got some good signals this week in terms of excesses on the currencies, and the U.S. dollar, it peaked out on our momentum signals about a week ago. Put in a marginally higher high the early part of this week, but no follow through. And the dollar index looks as though it's finally ready to have a correction. I mean, this has been, I can't count this right now, but it looks like about 10 to 12 weeks of consecutively higher lows. And on the week, just closed marginally lower. So I would suggest that there's some follow through probably to be had on the downside for the dollar index. And when we take a look at things like the euro, we've got good signals here from the commitment of traders numbers, signals that would show a buy for the euro. So the inverse of that would be a sale for the dollar index. And you might take a look at things like the UUP as an opportunity on the short side of the dollar index. That's been a pretty good run, 27.5 up to 30, probably comes back to 29 or under. So a decent correction to be had in that ETF.
What's going on with crude?
We had our upside exhaustion numbers that we were looking at here a few weeks ago, middle of September. I think it was about the 19th. And you had one final push to $95, which was just a major signal in terms of the divergence, bearish divergence. When you look at the RSI, you look at the demand index. And so from that, we expected to see a correction back in particular towards the 20-week moving average. And we got exactly that this week. So it's now quickly given back 38% of the rally off the low, hissed its 20-week moving average, and became oversold on the daily charts. So this looks like a good spot for the correction to hold on crude. And if it can pause around here and not give up any further ground, then I think it's got more legs to the upside for now.
What's going on with gold?
The gold market and the silver markets both put in sequential nines. That would be 9 consecutive days with closes below 4 weeks earlier, 4 days earlier, sorry. And that then sets up for a pretty good bounce off the low. Typically, you would see a rally of a few days, come back down and retest the support areas. And if you can turn from there, then we could have a more prolonged move on the upside. So at this point, the gold market's probably good for maybe another $20 or so in terms of a pop. It was a good reversal at the end of the week to the upside, and support, as I say, probably look for a retest of the low, If we can have that and it holds, then you get ready for your seasonal. And the seasonal in the gold typically would be into November, December for a low from which you can have a pretty good rally. It might start a little bit earlier this year because we've already seen this good reading on the downside. So we're going to be pretty aggressive, I think, as far as looking at not only just the bullion, but also the miners here in the next few weeks.
Anything going on with uranium?
Yes, this is another one that gave us some really good signals on the highs, in particular the uranium itself has had that retracement rally up to 75, which was just a perfect target area, and it's having a little bit of backing and filling right now. And if we look at something like Cameco, the target there had been at $42 US, that's the CCJ, and had its first little pullback from that 42 down to 36. We're getting a bit of a bounce, but one more push down, I would say, to 34-ish, maybe a little underneath that. You might want to take a good look at Cameco. It's been good to us for the last 3 or 4 years. We've had some good opportunities in and out, and be looking for another opportunity to step in if it can correct down around 34.
Ross, thank you so much for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark from ChartsandMarkets.com. Find him on X at Charts by Ross. Coming up, Danielle Park next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website's JugglingDynamite.com and VenablePark.com. Welcome back to This Week in Money.
Thanks, Jim.
Danielle, can you tell us a little bit about Venable Park Investment Counsel Incorporated?
We're 20 years as independent value, absolute return asset managers. We only work for the clients. They pay us an annual fee for assets that are managed, and we don't have any other products. We don't sell anything. We just manage risk, life savings. We do independent analysis of all asset classes. We don't have a particular bias towards one over the other. And, that's basically it.
And of course, your original background was that of a lawyer. So does that give you a different perspective when it comes to analyzing what you should invest in?
Well, that's an interesting question. I think it does. I think that, there's been a lot of talk in the last couple of years about the fact that Jerome Powell is a lawyer by training. He wasn't a PhD economist. And I think that he surprises people sometimes in the decision making that he makes. That's, he breaks with his committee, which tend to be all PhD economists. And I think that lawyers are trained to look at what can go wrong. Obviously, hopefully things go right most of the time, but it's when things go wrong that the poop really hits the fan, that, lasting damage is done to people, parties, the economy, accidents happen, all this sort of thing. And basically that's the job of a lawyer, is to try and assess risk, to try and provide for that risk, or to make, to adopt rules or processes to help minimize the damage that comes out of things. And I think that's been, that was certainly my initial training, and I still, of course, am a lawyer. And I also, afterwards went into the investment banking business, and quickly figured out it was a completely different world. It's driven by salesmanship, equity culture, primarily biased towards getting people to buy risky assets where the fees are the highest. I was quite horrified, actually, when I went from law into finance. And becoming a chartered financial analyst, I realized that has more of certainly a rules-based assessment. There's, it's math-based, it's formulas. But my greatest takeaway was a revelation that, this is all they know. So I guess that went back to, if this is all we know, if we're trying to anticipate future events which are largely unknown, how can we set up rules and procedures and behaviors that will protect us regardless of the outcome? And I think that is probably the biggest thing that has stayed with me throughout my career.
We're now in October. The stock market bears are out in full force. What are your thoughts on the stock markets?
Well, the stock market has been heinously overvalued, since the pandemic hit, and all the free money was thrown at it from central banks, through quantitative easing, through zero interest rates, which followed after 10 years of rates already being at 5,000-year lows. Fiscal policies aimed at getting people to take on debt to buy properties, in real estate, where, we have the capital gains exemption in Canada, where we had a bunch of federal programs trying to get mortgage rates down. All that was really pushing debt and leverage into the financial system. And the stock market was a benefactor of that. So we saw that, there was, when money was paying nothing, people were doing anything and everything with it. The cash flow was flowing, but there wasn't a lot of thought or analysis going on. And I had lived through a couple of those periods before, in my career, from the late 90s into the tech bubble, and in the 07 to 08 period. And then, again, leading up to just before the pandemic hit, we were already at pretty bubbly valuations and everything. We'd had a long expansion off the prior low in 2009, and we'd had this decade of QE. So everything was pretty frothy even then. And then, of course, they threw even more money, which was backed by debt, but added debt and stirred even further. And that really inflated everything to back up to all-time highs of more than a century, sort of valuation peaks that we hadn't seen since the tech top in 2000. So now, with the rate hiking cycle that happened, we got a big sell-off in every kind of asset really in 2022, which was across the board and really justified if you think about it, because the 13 years of near zero interest rates emboldened what we called the everything bubble, and that was where everything was largely overvalued, even bonds, but yet there was literally nowhere to go. Cash was paying nothing. Equities were extraordinarily overvalued, and have no maturity dates, no guarantee of principal return, no even guarantee of income, because dividends can certainly be cut if a company gets into financial strain, and they do that. And so there's no guarantee of any kind with equities. So that made us very concerned about them then, and in 2022 that was really justified or was shown to be correct, because everything sort of tanked together. Then we got a big rebound in again, that handful of tech companies, the ones that could do no wrong in the speculators' eyes, the Apples and Microsofts and Amazons and Teslas of the world, which were trading at, incredibly high valuations. They rebounded between, sort of January. They sold off again in March on the big swoon in the regional banking system in the United States, and then rebounded sharply again into July. But then since then, we've had the next phase, if you will, of this bear market, which I believe has been ongoing now since late 2021. It's been our thesis throughout that was a bear market rally that happened in the first, 6 months of 2023, that it wouldn't be sustainable, and that the push towards higher and higher capital costs in the economy were going to have their normal way with financial markets, which is to say, when cash rates are 5% plus, there is a competition for who's going to attract inflows, and that winner has, it's the risk-free rate. Cash or T-bills are the risk-free rate. So if equities and corporate debt and other securities want to attract capital, they really have to offer something more attractive than just the same, yield as cash, and they aren't, right? Across the board, the yields have continued to be much lower than cash rates, certainly in the equity sector, because, again, prices have come down. In some sectors and areas, they've come down significantly, but they're still overvalued. And because the broad market is held up by this basket of stocks, which has again been faltering of late, but they are sort of the last holdouts, or the last legs holding up the U.S. markets for sure. And in Canada, of course, we've had a rebound in oil prices in the last few months because of the, Saudis cutting output because they see the downturn coming. The credit cycle is leading the economy into a downturn. We've had 17 months of the leading economic indicators contracting. We've had an inverted yield curve for 16 months. We've had, a lot of the harbingers of recession very evident writ large for many months now. And so the oil producers are concerned that will mean less demand, as it always does. And so they're trying to kind of hold up prices by curbing their output. So that has, again, given this boost to oil and gas prices, which has given this boost to the TSX for a while there. It did because the TSX has a large weight in the oil and gas sector, but its largest weight is, of course, in financials. So that includes banks and lenders and all of the sector that is in the throes of a major sort of credit attack right now because they are having to pull in so hard on the loans they're making while their defaults are rising. Loan delinquencies are rising. We've got a classic credit crunch going on throughout the banking system in the world, and that is really hitting the lenders' profits. And that is a function of why we are still very concerned about the Canadian stock market. And the downturn that's happened in the past couple of weeks is really exactly what we expected was going to happen. And you're never sure, when, but when you know that something has been juiced so much by speculation and free credit and really is not supported by fundamentals or strength, you know that it's not long for this world. And so the selling that's happened, through the month of September and even into this week, is perfectly in line with what we thought would happen, and we don't think we're finished yet. So it's more of a how long is it going to take for the mean reversion process to complete, and ultimately that has always happened historically several months after central banks stop hiking rates. And if they've paused now and are not going to hike anymore, that certainly doesn't mean the stock market is out of the woods. And in fact, to the contrary, the bulk of the losses typically flow after that pause and during the resumption of rate cuts.
Are there any stock market sectors you like right now?
So there's some that are definitely showing some promise, and we're quite encouraged by that. We personally like to have a good amount of our portfolios in income-producing instruments because that is where the compound benefits, compound returns over time. Everyone talks about the miracle of compound interest or compound income, and that's where the bulk of stock market returns and bond market returns, every kind of return has come from over the years. But when yields were so pathetically small, of course, that was a major hindrance to the compound return that one could generate on their savings. So as we look at the targets that we hope to add to portfolios in this next phase, it's, a return to things like the financials, the REITs, preferred shares, dividend-paying companies, and then, that's also like a year ago, we were less excited than we are now because financials are off about 23%. So the REITs are off 32% from their peak in February of 2022. Preferred shares have come off about 28%. Many of the dividend-paying targets that we have are off more than 20%. So certainly going in the right direction. So far, the energy companies have only come off about 10%. Again, that's one of the last legs holding up the TSX even as it is. And the TSX has had, a very lackluster performance. It's now negative year to date, thanks to the selling in the last month. But it is also just, a fraction of its returns over the last. All it would take is a bear market of about 20% to return the TSX to the same level it peaked at in 2007. So 15 years ago, it would just take a 20% decline from here to be back to that. And, in this kind of, if we get a major recession here, which is housing-led recessions or downturns tend to be the worst historically, the most severe in terms of contraction in employment and economic activity. That's what we seem to be having. We've perfectly laid it up here because of all the bubble conditions during the pandemic and all the free money and debt. We're starting to see the unwinding of that. So we're expecting that you could get a greater than 20% decline in the broad markets here. It would be typical to see more like a 40% decline during a recession, just as we did in the 2000 and 2007 downturns. And at that point, the TSX, believe it or not, would be back to where it was in 2000, 23 years ago. And that was actually our concern back in 2000, was that things were so overvalued that you were entering what we call the secular bear period, which tended to be a couple of decades of sideways churning markets that don't really get anyone far over the course of the experience. And I still think that's the base case here. I know we've had a lot of money thrown at things to try and fight that gravity, if you will. But at this point, we're thinking the downside for the TSX could be greater than 20%. We'll have to watch things as they unfold. But yes, I'm getting really encouraged that these things we've been waiting to buy are certainly coming down in line with our expectations. Unfortunately, I think we're about halfway perhaps there on many of them. So we still have to wait a bit longer. But, the great thing about cash, or the money you have set aside for these purchases, is you're making some income while you're waiting. And then as things come down in price, you're making, the opportunity for much higher yields as that happens. And that's already been transpiring, like the preferred share ETF is now generating over 6% in yield. The XRE, the real estate trust, is almost about 6%. Financial, index is yielding almost 4%. So these things are certainly coming up. They were a fraction of that a year and two ago because prices were so much higher. So that's the double-edged whammy of waiting to buy them, because you get the price lower, so you get a much less price risk, much less capital risk after something's already come off its secular high. And then you also get this big bump in the income that it's paying out because you're buying it at a lower price. So if I'm looking for opportunities, if you ask me where the opportunities are coming, they're going to be in the income-producing sector. Even if the economy is slower to recover because we don't get a big rebound on, endless stimulus the next time, if you're getting great income yield and that's compounding over time, your returns are going to be very robust, and that's an exciting thing.
What indicators do you watch to see where interest rates are headed, and what are those indicators telling you?
So essentially, they're greatly influenced on the short end, of course, by central bank policy. So as we've seen in the last couple of decades, when central banks want to really, lean on the short end, push overnight rates down, they can push lending into the banking system, push the offering of credit, expand that through the economy. And to the extent that people have income that they can service that debt with, or enough income to do, that they will take on debt. We've seen that, and incredibly to their own destruction even. They will continue to refi their house or continue to add lines of credit or whatever they can, so long as interest rates are low. But ultimately, the longer end of the spectrum of the yield curve is set by the bond market. So we pay an awful lot of attention to the bond market, because that is where, for example, base rates for mortgages and car loans and all that are based off of the bond market, which the central bank does not control. They do try and have an impact on it through things like quantitative easing, quantitative tapering, which they're doing now. Quantitative tapering is, the U.S. Fed is continuing to take about $95 billion a month off of its balance sheet, but its balance sheet is still about $7 trillion today, which is just mind-blowing. So as they roll that debt off and don't renew it, that is another thing that's contracting capital out of the financial system, and ultimately so that those are short-term effects. But the longer-term impacts, as I say, are driven by the level of debt and demographics. So if you've got a very aging population, their consumption naturally falls, and that tends to be a disinflationary force. At the same time, if you have a lot of debt weight in an economy, even if you cut rates, at some point a person only has so much income. So once they're highly levered, highly indebted, they really aren't in a place to add much in the way of debt. They may refinance some of their debt at lower levels in order to increase their ability to service it, but there is an end point. So it's very important to watch macro trends with respect to things like that and demographics and productivity, because that can increase your efficiency and output. But they've done so many studies, whether it be, the Rogoff and Company in 2011 with their book, or whether it be the San Francisco Fed just released another study that basically shows that central banks can, have an incremental, in fact, a short-term boost to consumption and demand based on manipulating short-term interest rates, which is floating rate debt and, overnight rates in the banking system. But ultimately, when they do that to such an extreme that they add so much, they encourage so much debt creation in the economy, ultimately they have to go back to hiking rates, because they've created an inflationary impulse, which is exactly what happened this time. And once they go back to hiking rates again, that slowing impact, because so much debt was taken on during the cutting phase, when they go back to hiking rates again, it has a really heavy impact. And that impact actually slows economic output for years after the effect. So it really is a case of can kicking, to goose the short-term demand and make money really cheap in the short run. All the studies show that ultimately you're just making things worse and slower in the long run. So now we've got that give back period, where the as I say, demand is turning down. It naturally would with an aging demographic anyway, but now we also have the weight of all the debt that was accumulated. So it's important to understand, what's driving things in the short run, and to kind of be a grown-up about it, because you can't predict, of course, no one knows the future exactly. And certainly, things like a pandemic, or, like a catastrophic weather event, or, 9/11, or these things that happen, there's no way that you're going to know exactly where those things come. But ultimately, this is part of the drown-proofing, and trying to imagine if things went wrong, how would it hit? How would this impact? How stable would this person, company, economy be? And so those are the things we pay a lot of attention to.
If interest rates just stay at this level without rising, what effect are they likely to have on the Canadian economy a year and a half, or even 2 years from now?
Well, so changes in policy work through the economy at a lag of 12 to 24 months typically. So that's why, for the beginning parts of this hiking cycle, everyone was like, oh, well, they've increased rates a lot, but everything's fine and everybody's buying houses and it's all good. Well, it takes a while, right? Because a lot of debt is fixed and doesn't come up for renewal for a period of time. So that's why historically we've always, it's like mind the lag, right? It takes a while to move through. And so that that's why we are just now starting to really feel the main meat of the hiking cycle that began in March of 2022 and 2022. And the thing is that even if they go back to cutting rates in the not too distant future, which I think is likely in sort of by mid-24, they'll be probably trying to rescue, falling asset prices by slashing interest rates. But even then, it takes a lag of 12 to 24 months to really filter through or make a difference. So we know that the tightening they've done to date will impact for the next 5 quarters, regardless of what happens next. So regardless of whether they hike more or stop, or even if they went back to cutting interest rates again, over the next 5 quarters, the impacts are going to continue. And if we believe the longer term studies, like the ones I mentioned from the Fed, the San Francisco Fed, and many other organizations who have done this work, that the slowing is actually going to continue for years from here, not just a few months. So that's, I guess, the nub of it, is that we've kind of baked this pie by the many years of debt inflation through very ultra low rates. Now we've had a normalization of interest rates, and because the debt weight is so heavy in the economy, we are now going to have to pay that back over, whether it's through bankruptcies and insolvencies or just paying back. It's going to take a long time. So it's going to be a depressive effect for a considerable amount of time here.
Is the tightening of credit the elephant in the room?
Well, I guess in what I was just describing, again, in the beginning, everyone's thinking, so they're tightening, it doesn't seem to matter. Look, everything's still good. And but in fact, bank lending to consumers is contracting. It's at the lowest level since the recessions of 2020, 2008, 1980. So we know that consumers are struggling. Business sentiment is terrible. Business bankruptcies are spiking. Consumer sentiment is very negative, all these things. So I guess, I don't know if it's an elephant in the room anymore. I think it's more like an elephant sitting on people at the moment. They seem to be very stressed out.
Is the record amount of debt ever likely to be paid back?
Well, if you look at the history of these things, it's a process. It's a bunch of things. A lot of times debt is simply refinanced at lower rates eventually, which makes it more manageable over time. If you have sufficient income growth and profit growth in an economy, debt payments can be made, which is why they like to have an inflationary bias rather than a disinflationary bias. If you have a disinflationary force in the economy or a deflationary force, incomes tend to stagnate, and then it makes it a lot harder to pay back debt that's been taken out in the prior period. So I think, there'll be some of it, certainly. One of the interesting things, for example, with the student loan abatement that was going on over the past 3 years was, they put it on hiatus, and people were like thinking, maybe there was a lot of talk about expunging it and not having to pay it back and all that. But there's a certain cohort that owns the bulk of that debt, because if you have a professional degree, you tend to have spent a lot more trying to get it. You tend to have some of the American counterparts will have $200,000 and $300,000 of student debt. It's mind blowing when you think about it. And that hiatus came to an end in September. The interest started accruing again. Of course, at current rates, that's a lot. And people have gone back to making the payments to the extent they're able. If they have income sufficient to actually make the payment, they've gone back to doing it because, again, the cancellation programs tend to be for people with much lower incomes or, no ability whatsoever to pay it back. So I guess there's always going to be a certain amount of debt that's resolved through bankruptcy and write-offs because it was bad money. It should never have been, loaned to the extent it was or to the people it was or to the degree it was. So there's always going to be a certain amount of the debt that's wiped off. But then a lot of it will get refinanced and paid back slowly over time.
It looks like the homes for sale inventory is growing, but what would a housing crash do to the Canadian economy?
Well, Canada is extremely vulnerable. I've been talking about this for a long time because you could see it, building and building and building. We were putting 40% of our capital stock into just the housing sector for the past, many years. That was a misallocation. We should have been doing much more innovative things like building out our infrastructure and our energy systems, things that would improve productivity and lower costs and lower pollution and all these things. We instead, took lower rates when people, in the 1980s, rates were much higher and people would have 1,000 square foot house. And when rates, became a fraction of their former self, instead of using that opportunity to pay off debt much faster, which would have been great if people had done that, instead of that, they, started buying houses that were 4,000 square foot, just because they could, service the payments because interest rates had come down so much. So what that means is we have this huge stock inventory of massively expensive properties that very, very few people can afford to buy today. It's really crazy. Like if you think about it, if you have a household income of $200,000, which is only 10% of the Canadian households have that much. If you had a $200,000 down payment, Jim, today you can qualify to borrow about $639,000 because the current rates are around 7%. And even at that, your payment is going to be nearly $5,000 a month over 25 years. And that's for, allowing you to buy an $840,000 house. Well, those would be considered starter homes in Canada at this point. And I can tell you not many new families, immigrants, or starter people have that kind of income and or that kind of a down payment or that kind of an ability to service that. They have other payments, typically other costs, whether student loans, cars, all these things. So all of that really just depletes your ability to save in households, and companies have done a lot of destructive stuff with their capital as well. So it has left us extra vulnerable this time. And the last time Canada saw a really bad housing-led downturn was 1980-81. A lot of people alive today don't remember that, or they didn't have any, money to lose at that point, or they didn't own a property. But, I certainly remember it. I was a teenager. I remember my father's a builder. I remember a lot of the things that went on at that period. And I also remember in the 1990, again, we had a relapse in the housing sector. And basically, properties were stagnant or about the same price for about 15 years there, believe it or not. So I know that that's actually quite typical. When you come out of a big bubble, you get the burst, you get prices coming down typically 4 to 6 years before you get a bottom. And during that time, the people that are holding on, again, if you look at the data, yes, a lot of Canadians had locked in, in 2020, 21, 22 at very, very low interest rates, but those were always 3, 4, 5-year terms that are coming up for renewal, and we can watch that coming. Just like you can watch a demographic bubble, you know exactly how many people ought to be about this age about 5 years from now. Well, we know that most of the mortgages in Canada, actually all of them, will be up for renewal over the next 3 years, and they're all having to deal with this shock in terms of payments. And even if central banks go back to cutting rates, I doubt we're going to see anything like we got in the prior period, in the experimental period where they were flirting with 1.5% mortgage rates. You might get them back to 3 or 4, but that's still not going to be enough to bail out a lot of people who bought these extremely overpriced abodes at 1.5% or 2% interest rate. So the problem is the price. Essentially, it's not that rates are so high today; it's that the price was so ludicrous that people bought at, and that the debt levels were so massive. So as far as what we know, for example, in places like Toronto, the September seasonally adjusted sales to new listings ratio fell to the lowest since 2008. And new home buyers today are having to qualify at a stress test rate of around 9%, Jim. No wonder new mortgage demand is at the lowest in about 27 years. So all of these just go to show that we're going to see, I'm certainly seeing it in the GTA, the increase in new listings is just relentless. there was all that talk of, well, there's no inventory and, people just won't move. But in real life, people have to move. People move for all different reasons, whether it's marital or health or new jobs, or whether it's just a function of, wow, during the pandemic, so many people borrowed against their house to buy secondary properties, whether it's up in cottage country north of where I live, or whether it's, rental properties that were negative carry that didn't actually pay for themselves. Well, all those things are up for a fresh reprieve or a review in this environment, because people are now having, they're servicing 2 or 3 mortgages and other loans in an environment where we have the highest interest rates in, 20 years in some sectors. So that is, I think, going to continue to weigh on the Canadian housing market. I think we're likely to see already there's many listings in the north of Toronto area, where stress is starting to build. The lenders are starting to put things to the lawyers to start to get, eviction and foreclosure proceedings underway. Those are coming across deaths of judges in the country. It's really picking up. So I think that we're going to have to deal with that weight, that, forced liquidation, that price discovery, and ultimately the contraction in the construction sector, which ultimately always leads to a lot of job loss, even in an economy that was less levered and dependent on that sector than Canada was. And Canada is about the worst of the G7 for its vulnerability in this regard.
Are auto sales a good indicator of economic trouble ahead?
Well, we have this weird phenomenon with auto sales. The answer is yes, and it's a very cyclical pattern in terms of a peak in sales, the credit cycle, because it's a highly financed asset. Next to housing, it's the most financed asset. And so certainly there was a period there where during the pandemic, people were not able to get cars, whether it was the chip shortage or just exports were, bogged down, and unloading of new shipments to North America was all backed up. So there was a lot of reasons why people couldn't get vehicles during the pandemic when they wanted them. Again, when rates were, virtually zero and there was all this free money flowing, people had cash, but they couldn't get product. So that had the effect of driving up prices. Again, very expensive across the board for all kinds of vehicles. That's taken some time to abate as well, because there was year-over-year increases in sales were so high. But then last September we had a big slowdown in terms of the amount of sales in vehicles. And now we're starting to see people with the average car payment is more than $750 a month just for the car payments. So this is more like, what an old mortgage payment used to look like. People are paying $1,000 a month in many cases on their vehicles. And so we're starting to see that demand cooling as inventory is backing up on a lot of dealer lots, that panic to try and get product at all costs. Now people are sitting with a lot more product than they, feel comfortable with. And there's a finance cost to that as well, right? The dealers are dealing with interest rate shock as well. So I think that, we're probably going to see a downturn. It's very common to see the unions all striking at the peak of economic cycles because the cost of living typically spikes, and they, are having a hard time making ends meet. And so they also see all the C-suite class, executive class making off like bandits with their share buybacks and, ludicrous levels of compensation, which has been just off the charts in the last couple of decades, just getting worse and worse. And so the working people, it's very common for them to strike. But ultimately that's a sign of a top typically. And, as unemployment rises, the workers get the hit of, starting to lose their negotiating power and all that sort of thing. So it's very much part of the business cycle.
Do times of turmoil create opportunities, and what could some of those opportunities be?
Well, of course they do. And I guess that's the silver lining. Unfortunately, you don't want to gloat, seem happy at other people's misery, because there's a lot of misery building, and there's going to be more of it here. But the only thing you can really do is control your own behavior and control your own spending and your cash flow and what you've got your savings in at the peak of a cycle, and maintaining liquidity and maintaining things that have guarantee of principal and that sort of thing, so that you can have access to capital to buy things after it's come down in price. So I think the opportunities this time, we had the everything bubble, we're having the everything bust. That means that you're going to have, to the extent that you have capital or can access it, you're going to have opportunities to buy real estate at pricing that would not have been even imagined in the last 5 years before this. You're going to have an opportunity to buy, as I say, a lot of these dividend-paying equities that we're watching carefully, because as the price comes down, the yields fatten up significantly. So I think it's going to be a case of everything's on sale. Corporate debt, the spreads are finally widening, so the credit that's junkier credit is finally starting to pay 7, 8, 9%. There's a bit further to go there. Again, it was priced like it was government bonds a few years ago, because if the risk-free rate was at 0, then the corporate debt was, paying 3 or 4%, and that was not nearly enough compensation for the credit risk involved. So now you're getting to see things paying 7 or 8 or 9%. That's heading in the right direction. But again, I think you have to kind of stand back at this point and let the chips fall. And then, have your buy lists, have the ideas of what you're interested in adding to your, whether it's a home or to your investment portfolio, to your savings, and just basically be ready with some liquidity, because there's going to be a lot of things on sale.
Danielle, where can people follow you?
Basically, jugglingdynamite.com is my financial blog. I write for free and most days of the week. And that's sort of a public educational portal that I like to do. And our firm site is Park.Stock.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Coming up, Mark Leibovit, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be back, Jim. Thank you.
Mark, can you tell us if there's a special offer for our listeners this week?
Well, I try to keep it going through House Street Radio. It's 50% off any of the VR Trader subscriptions, and when you'll go to the order page at vrtrader.com, you enter the promo code 2022 half off 2022 HALFOFF, and you get half off any of our products for any time frame you sign up for. It could be 1 month, a year, and so forth. And also, just want to make that same disclosure that I've been writing this newsletter now, believe it or not, 44 years. I'm not a financial advisor, nor do I provide financial advice, but we do our educational reports and our analysis of the markets and stocks joyfully. It's just an exciting business, and we just keeps us going all these years. It's something new every day.
Mm. And can you maybe tell us a little bit about VR Trader?
Well, it's a technical service, but we've incorporated a lot of other goodies in there over the years. Cycle analysis, for example, contrary thinking, for example, the theories of market manipulation, which are really there and real, though they're not talked about. We've got in fact, just getting off on a tangent for a second, I'm listening to CNBC today, and they had one of the Nigerian brothers being interviewed, or maybe it was Fox News, I'm not really sure, and he actually mentioned the market may have been up today because of the plunge protection team. I haven't heard that mentioned in the media at all, and I'm the only one who's been talking about it that I know of, but I don't listen to every broadcast or read every comment. So he's talking about it on national television, and it's a real force in the market. I mean, we know Japan's out there, manipulating their equity markets and buying ETFs and stocks, and it's just not discussed here. But anyway, the U.S. market was up today, so he attributed that action on the part of that agency as part and parcel to the rally. In any event, we do incorporate a little bit of that into our analysis and cycles. We talk about the autumn, fall, summer, cyclical changes in the market. We just came out of the autumnal equinox on third week of September, and sure enough, the market bottomed on September 29th, October 1st time frame. And we look at lunar cycles, but primarily we started with our volume work because that's what VR stands for, volume reversal in our VR trader. It started with the concept that volume precedes price, and everything I generally do, I look at the charts, and is it volume coming off the bottom? Is it coming off the top? We saw that, for example, in Apple Computer just recently when it topped out, and we saw it in other, big names coming off the bottom, like the oil stocks in recent weeks. So, you want to see that volume shift. So you want to put all the pieces together. Just can't be a one-trick pony. There's just too many variables. You want to see, is there good news at the top, bad news at the bottom? Is it confirmed by volume? Is the cycles in the right time frame? Or you're in a period of time where the market tends to go down or go up? So most people who listen to this broadcast are pretty aware of the general market cycle. So, but we do it on a very short-term basis as well, and have done it for all these years. That it's fun to try to put all the pieces together. So that's sort of the story of VR Trader.
Now, the U.S. House of Representatives just fired its speaker, and then they promptly went on holidays for a week. And the market went up. Does that mean the U.S. economy works better when the government is sort of rudderless?
Right, that the market loves it. When there's a stalemate, between the Congress and the president and so forth, or the Senate and the House versus the president, and nothing can get done. The market loves it because common sense. These are a bunch of buffoons who don't know what they're doing. They're funding Ukraine, which is a big mistake. When they don't protect the border, the southern border in the U.S., which is much more important to the American people. And they spend money like crazy, and they just are just crazy in the kind of programs. And for example, Trump had the wall going up, they stopped it. Now Biden's talking about getting it going again. I mean, these people just don't know what they're doing. They're affected or influenced by by money. As in the Biden situation, lobbyists. It just. Does the country come first? Are they really there to do the best for the country, or are they doing the best because their party line tells them to do something, or they're being told to do something and they just, follow orders? I mean, the fact they're not around, it's great. I mean, the fact that the House kicked out its speaker, which is the first time in U.S. history, just shows how inept the whole process is. And unfortunately, the public suffers by this, and we've got just big problems, and that's one of the reasons why the Federal Reserve was brought into existence. They couldn't handle it, so they threw the ball into the court of the Federal Reserve, and they blew it because they don't know what they're doing. Any government agency is a negative factor, whether it's the Internal Revenue Service, whether it's the Environmental Protection Agency, whether it's the CIA, FBI, they're all a bunch of buffoons, in my opinion, over the years. They've proven it. Mistakes, financial mistakes, political mistakes, biases in the wrong direction. So, I'm a long-winded response. The fact that stalemate is good.
What direction do you think the stock markets are headed? A lot of people have described it as being at a crossroads. Could either go a lot higher from this point, or we could be on the verge of a major correction.
Okay, well, it depends on your time frame, Jim.
Yeah.
Long term, you're in the market because in the last, 100 years since the crash in 1929 and so forth, zigzag higher over time. So if you're young and you have a long time frame and you're putting money away, you just keep putting it away in dollar cost averaging because you get the zigs and the zags, but by the time you're in retirement age, the chances are pretty darn good it's going to be much higher, okay? So, if you're trading, that's a whole other perspective. We have a presidential election next year. I talked about the plunge protection team and market manipulation. There's a lot of pressure on the Federal Reserve to change its course and interest rates, which they may or may not do if they follow Paul Volcker's plan of the 1979-80 period, that rates are going to go a lot higher and disappoint a lot of people, but there are also political pressures. So it's tough calling, an election year coming up next year in terms of how the market, should or could respond. Normally, I'd be more bearish. There's a lot of factors for that, and the internal market is very weak. I've talked about this before on the broadcast, but people were talking about the great bull market we had, but I looking at the Russell 3000 index, not the 2000 index this past year. Over 54% of the stocks in the Russell 3000 were actually down, even though the S&P was up, I think about 8 or 9% or so. So most stocks did not rally this year. It was mainly the Magnificent Seven, the big seven stocks, Netflix and NVIDIA and Facebook and Microsoft, and Tesla and Apple and that whole group. Those seven stocks weighed the averages up and the S&P up, but most stocks, as reflected in the Russell 3000, did poorly. So we really didn't have for 54% of the stocks in the Russell 3000. And the Russell 3000 represents, I think, 94% of all the investable stocks in the U.S. market. You didn't make money. And everybody's talking about the bull market and how great the market did since last year. I guess you owned those seven stocks and nothing else, but most stocks really didn't do that well this past year. So, the internal market has really been awfully poor, and rates are still going higher, and we have terrific risks with the Taiwan-China situation, with what's going to happen or not happen with Ukraine and Iran, and geological, geocosmic factors, all kinds of crazy stuff, that's coming up, and is the offset the political environment and the presidential election? Time will tell, but I honestly overall feel that we're going to go back to the lows of 2020, the COVID lows, before this is all over. Maybe it'll be after the election next year. Maybe you'll have some outlier event. I always talk about outlier events. We say an outlier event's going to hit, and this thing with the U.S. House of Representatives, which is the first time in history even happening, suddenly came out of the blue. Or the balloon flying over North America, or COVID, or all these incidents that suddenly come out of the blue that nobody even anticipates, or you could even speculate about things because they never occurred before. So these are the variables. So we tend to trade. We made nice money on the oil stocks. We called the bottom. We actually sold them recently, and now we're getting back in again. They corrected, had a nice run. We're looking at what the dollar is doing relative to the precious metals, and we're in the cyclical time frame right now. Our model, which we put on our website, basically said, top in July, pull back into late September, maybe early October, then you get a rally, and then you got the Santa Claus and Thanksgiving effects coming up. So, there's a sort of a tendency to try to rally into the end of the year, and we just sort of take it, day by day here. So, I guess I'm leaning a little more bullish short term because the cycles say that we should have hit or about to hit some type of trading low this time of year. But you got to be real nimble about it because there's all these outlier events affecting the market, and the market is mistakenly holding its breath for the Federal Reserve to lower rates when there's so many other factors besides that could affect the markets, and they're not even really discussed that much. So the world's going to jump on whether the Fed's going to do something or not doing something. I've been writing about this for decades. The Federal Reserve should be abolished. I mean, they've done a terrible job, even even back on the 2008, 2009-10 period. Bernanke, who was in charge of the Federal Reserve, actually came out and stated that the depression, the U.S. depression in the 1930s, was actually exacerbated or caused by the Federal Reserve because they raised rates during the time when an economic slowdown was occurring, and actually made it worse than it could be. And maybe that's what they're doing again now here in in the 2020s. They're raising rates at a time they shouldn't be doing it, just like they kept rates low for 10 years when they shouldn't have kept rates at zero for 10 years. So it's just a bunch of inept people running the financial system, and for some reason stocks still do their thing. Oil stocks take off, or gold stocks take off, or cannabis stocks take off, or defense stocks take off, or uranium stocks take off. There's always plays, and you just got to find that expression that I guess Jim Cramer always talks about at CNBC. We'll find a bull market somewhere. There's always some money moving into some opportunity, and to me that's more important than answering the question, am I bullish or overly bearish on the market? I mean, overall more bearish because of what I think the fundamental picture is like and the risks are in the world, but it doesn't mean we can't have some one hell of rallies and declines along the way that we can make money. So that's sort of my answer now. I'm just leaning a little more bullish here because of the cycles, but treading lightly, just knowing that a lot of it could be manipulated.
Now, it seems central banks in Canada and the U.S. are hell-bent on destroying the economy as much as possible by hiking rates. And we just had good news on the job front, 330,000 plus jobs created in the U.S. when they expected 170,000. In Canada, they expected 20,000, about 60,000 jobs added. Are they not going to be happy until there's blood on the street and people are losing their homes and can't find a place to work?
You can't help but think that could be the case. And if you read the details of behind what the Fed is really all about, at least the Federal Reserve, Congress will spend money until there's no way to spend it anymore. But one of the edicts for and guides for the Federal Reserve was full employment in the U.S. I think economic stability and full employment is actually in the charter of the Federal Reserve. And to even think that they would try to drive employment down is, another reason why they need to be abolished, because they're not following their own guidelines, and they can't control inflation. They think they can control. Can they control the cost of crude oil? Can they control Saudi Arabia if they're going to cut back on production? Are they going to cause inflation, commodity inflation around the world because of a war in Ukraine, or other or climate changes, or volcanic activity, or other things that could affect prices around the planet? And the answer is no. So the fact that they would even think that way, they should be fired instantly and replaced or abolished because they're not doing what they're supposed to be doing. They should be tickled people are working. See, the whole story out there now is, let's look for some bad news so that'll give the Fed less reason to continue to raise interest rates. But the good news keeps coming. People can get jobs. Of course, you've got this United Auto Workers strike going on right now, and that actually causes inflation because the car prices, if you can't produce cars, there's a shortage of cars, and that could drive prices up for existing used cars. And if you can't produce new cars, whatever's on the lot's going to be jacked up in price. So that's an inflationary factor. Can the Federal Reserve change that? The answer is no. So, what can I say here? It's the blind leading the blind.
And, of course, higher interest rates mean higher mortgage rates. And so your mortgage goes from $1,500 a month to $5,000 or $7,000 a month. Aren't you going to have to ask for a big pay raise to look after that? Well, isn't that inflationary?
You may have to get the sellers to finance the purchases of the house. I remember way back in my lifetime, when I was buying a house many years ago, and this is in that 1980 time frame when the prime rate went up to 20%, and we had this super inflation environment at the time with Paul Volcker and everything trying to control things. I remember I got a private mortgage on a house, and I was tickled to get it at 11.5%. back then because you couldn't even get the lenders to lend you the money, and if they did, it was somewhere in that 15 to 20% area. So, people around today who haven't seen that or experienced that, and they see mortgage rates of 7-8%, that's still child's play to compare to what could happen and may happen. The question is that going to stop people buying houses? So my story is essentially I negotiated with the seller and negotiated a private mortgage with the seller, now with a bank, so I was able to get the mortgage on a house, and maybe that's what people are going to have to do if the houses are not, if you can't get the financing or whatever, and the banks are not going to provide it, or they're too high and ridiculous, you just might have to negotiate something privately, but people still need places to live. There are shortages of properties around. Construction has been behind, and there's going to be upward pressure on home prices regardless of interest rates. So, it's going to have some effect, but like I say, you can work out private deals, and there's other ways of buying, homes and doing real estate deals other than through the financial institutions. And if the Fed really gets nasty, because they're already pretty nasty and stupid anyway, in my opinion, but, if they start cutting back the money supply, they've held it up. It's been drifting lower, but not really significantly. If they really pull the plug on money supply, then things could get really bad, because then there will be no credit around, or credit will be so extremely high it wouldn't possibly match what we saw back in 1980, and that could perhaps create more of a serious problem in the real estate market that I'm even thinking about. So it's just, we just got to take it a day at a time here. Like I say, the blind's leading the blind, and you just got to try to manipulate around the market as best you can. But and then we've got the digital currency issue coming. They're being tested around the world and around the U.S., and the question is being asked, are they likely to be accepted? Young people today are so digitally oriented and crypto-oriented and internet-oriented, they probably wouldn't even object to it. But overnight, you could see that affect your bank accounts. Well, suddenly, cash is not allowed. You got to do digital currency. You could be tracked. Your freedoms are in jeopardy. And to the extent that the government could monitor what you're buying, or even prevent you possibly from buying certain things because of their control of digital currency. And this is a big risk for the financial system, where it's not even talked much about, but it's coming, or it's being talked about. So I know the World Economic Forum, Klaus Schwab, and that whole group would love it, because it would, create more control for people and take away their freedom. And that's been what that whole organization is about. You'll be happy and you'll own nothing is their big expression.
Yeah, well, I'm surprised more Canadians weren't shocked and upset when the Trudeau government seized the bank accounts of hundreds of people who supported the Truckers' Freedom Convoy to Ottawa. So you have a particular point of view or political point of view, and the government seizes your money. What's to stop them from doing it again?
Absolutely, and that's the big fear of the digital currency. It's been a war on cash from the part of the government for the longest time. If you try to take cash in and out of your bank accounts or in any sizable quantity, you're tracked. And I don't know how far that goes, where they start interviewing you and knowing where your cash came from or where it didn't come from. And it's a barrier to your freedom. I mean, that's the best way I could express it. And unfortunately, the plan of government is to take more and more control of your life and your freedoms, and this is part and parcel to that. So, yeah, I'm very fearful of it. And like I say, many young people don't think much about that stuff. At least the interviews that I've done here, it's just digital, it's fun, it's like crypto, it's fun, we can do it on our phones, we can move money around, but they don't understand or really appreciate the complication of having government involved so much into your daily transactions and looking over your shoulder on everything that you're doing or not doing. So, we just have to hope that there is resistance to it and it's not accepted so easily, and it's delayed as long as it can be delayed. That's really what I'm hoping for, but we'll see.
Well, I've encountered kids just out of school and new to the workforce who didn't know how to make change when you gave them cash. They didn't know what a dime or a nickel was.
I believe it.
Also, though, in some countries, cash is still king. In Japan, because during the war and after the war, the banks collapsed. They still like to have a safe under the floorboards or in the closet, preferably, where they keep cash on hand, and people still make major transactions in cash because they don't trust the government or the banking system.
Well, I'm surprised the Chinese haven't become more aggressive in clamping down on that, since it's a communist state. So
that's China. Don't confuse it with Japan.
Oh, okay. I'm sorry. I thought we were talking China. I'm sorry.
Yeah. Where in China, their real estate industry is collapsing. Evergrande and Country Garden. Apparently, the boss of Evergrande is under arrest or under investigation for fraud. And in China, if your company is convicted of fraud, you don't pay a big fine. You get a bullet in the back of the head, and your family gets the bill for the bullet, or they don't get the remains.
Oh my goodness! Well,
yeah. Who wants to do business in China now?
Well, Japan is a great place. I've always wanted to visit there. I had an opportunity and spend time there. I think it's one of the great bastions of capitalism and freedom still left on the earth. And the fact that the Bank of Japan has been so independent these several decades, and the way they conduct business, and virtually snubbing everything else in the world. It's really interesting. I mean, their interest rates there are still virtually zero. They're talking about maybe going up a little bit, which frustrates, I'm sure, the Federal Reserve and others around the planet. But the fact they've been so aggressive on the equity market, supporting their markets over there, much to the chagrin of the rest of the planet, I really admire their version of capitalism, honestly. So anyway, I'm glad to hear that story about independence there with regard to cash.
I'm wondering if you're a Canadian or an American, if you could get a mortgage from a Japanese bank at 1%.
Anything is possible. Maybe that's where we have to go. We have to apply to Japanese banks for mortgage loans. I don't even know if that's doable. You bring up an interesting concept. Can't do it here. Maybe Japan wants to invest in your house.
Well, there was a time in the 80s they were investing in everything.
Right. I'm saying, I'm just wondering. Knowing that, I'm just wondering if we have access to Japanese financing in this country. Most of it is done through currency swaps and so forth, by exchanging the currency and so forth. But I'm not an expert in that area, so I'm talking out of my bailiwick.
What's going on with gold?
Well, it bounced a little bit here today. A lot of it, as we all know, or we think we know, because the market changes its interpretation of things almost constantly. I mean, it's inverse to the dollar, and the charts to me indicate the dollar looks awfully toppy here. I mean, it's got some trend lines it's sitting on, and if it starts to break here, you can see a nice move up in gold just at a time when the bulls gave up on it. So let's watch the dollar. And there are times where these markets move in tandem. They don't always go inversely to each other, and that's sort of the trick. You got to look at the charts on both and make sure everything confirms. So on a one-day basis here, last 2 days, gold's been looking better. Some of the gold shares have been acting a little bit better, coming off support levels. The dollar had a little toppy pattern on the chart, so let's see if that continues. I mean, my overall model, for the year said gold should rally here into the end of the year, and we'll see if that pans out. And I think that if that occurs, it would be coincident with a little weaker dollar. So let's see how it plays out. We're in there, so let's see what happens.
Do you think the U.S. is going to legalize marijuana federally and open up trade across the nation?
I think so. They're talking about it. It starts with some momentum, and then it sort of stalls, and then it starts and stops again. There's two aspects to it. There's the Banking Act, which is, making some progress, though there's some resistance to it, where, cannabis companies were treated illegally, or it was an illegal process, except in the state, even in the states, even that legalized them, but it was considered federally illegal. So the Internal Revenue Service, didn't allow cannabis companies to deduct expenses on their taxes because, quote unquote, they were in an illegal activity. So the Banking Act is supposed to get rid of that, supposedly, and that way you don't have to walk in with cash and deal. When the thing started, a decade ago in Colorado, everybody was buying, marijuana with cash and selling with cash, and their $20 bills stacked in boxes in the back room because you had to deal with cash. And some people are taking that cash and buying real estate with it. The people who are willing to accept cash for real estate, they had no way of moving the money. So the Banking Act's supposed to alleviate that. So it's way behind. And the other problem is not every state it's legal. Obviously, there's a whole bunch of U.S. states that's legal. Canada doesn't have this problem. So you got some states where it's legal. Majority of states, I think, are legal now, but there's still a few that are not. So that sort of complicates it. Then on the other part of the whole discussion is the rescheduling of marijuana from a Schedule 1 number down to number 3, which makes it more acceptable. You can buy it in the drugstore, I think, if it's on a Schedule 3, where 1 obviously was totally banned and illegal, and there's discussion about the DEA switching that, and that's been going on for several years. So, ultimately it's going to be bullish. There's still demand for cannabis. It's been around for thousands of years, just like gold's been around for thousands of years. These are just things that people use, and now it's become more accessible, particularly with CBD and everything out there, and people are getting more accustomed to marijuana-related products. So let's see if the DEA comes through on rescheduling, how fast that happens, and whether the Senate and House can get together on the Banking Act, making it, more economically feasible to run a business from not only a tax point of view, from a banking point of view. So, the place you can't open a bank account if you're in the cannabis business. So we need the federal government to step in here. It's about time already. It's almost 10 years since this whole cannabis movement really got underway. And there are people who feel that, cannabis is bad, just like smoking is bad, or drinking alcohol is bad. Well, we had prohibition, and that didn't work out. People are going to do what they're going to do. And I think inhibiting your ability to have marijuana or inhibiting your ability to buy alcohol or smoke, that's your own decision. You could say it's not good for you. Eating too much sugar isn't good for you. You shouldn't be eating cupcakes all day or, going to candy stores, but, people do it. So, it's about time. So I'm bullish on the industry. They had a huge shakeout. They mismanaged themselves. They anticipated regulatory change happened sooner that didn't happen, and we'll just see how the consumers respond to the products. And I think over time we should see a bit of recovery. The U.S. cannabis companies, by the way, are spending a lot of time on the subject. Have been doing well. Some of the stocks, there's one company called Green Thumb. They're buying back their own shares. They're profitable. So other companies like Canopy Growth or Tilray, which are Canadian companies, have suffered, mismanaged their businesses. Canopy Growth virtually went out of business. Its stock down to 50 cents a share from $58. Now it's back around $1. So obviously a lot had to do with management of the companies and spending their money. But some of the U.S. companies, like the one I just mentioned, have been doing better. So I'm optimistic. I think some people know how to run a business and realize there is a product and a customer for it.
Well, Canada legalized marijuana for recreational use October 17th, 2018. Friends of mine in Britain thought, oh, God, what's it like there in Canada with legal pot? Are there riots in the street? I said, one of the things I think maybe that's keeping Canadians calm is legal pot. And Alberta, the conservative province that was the most against legal pot, actually has the most marijuana stores in Canada, probably more than all the other provinces combined. There's one on every corner in Edmonton.
A lot of, here in Arizona, a lot of the senior citizens, Sun City and so forth, are big users of CBD and marijuana. So the seniors have medical ailments that this benefits. So the realization comes there's something here that's really good, despite the onus of the name, that it's bad for you. It's really not the case. You can overdo anything. It has to be the right, combination in terms of, what was it? The components of the marijuana itself, whether it has the THC levels too high or too low, and so forth. So there's medical benefits, and there's all kinds of research. Tons of anecdotal stuff on how marijuana can cure and help a lot of diseases. So some of the seniors have really jumped on this. At least I've seen it locally here, where they really use it for all kinds of ailments and stuff. So yeah, that's I'm very much a proponent of it. If you can use it for, just out there smoking to get high all day, that's one thing. But for medical purposes, I'm 100% behind it.
In New Westminster, one of the pot stores, Bohemian Marijuana, they have a full-time 10% seniors discount any day of the week.
Yeah, well, we do the cannabis letter. We are tracking, many of those shares, and you may want to check that out because many of them are really cheap relative to they were a couple years ago, and some of these legislative enactments occur. I think you're going to see some nice gains.
What's going on with uranium?
Doing great. Had a little correction. Some of the shares in the last few days started to come back a little bit. We've talked about this before. I can't put my finger on the reason why uranium, which has been, depressed for years, suddenly took off big. And I really can't answer the question. I mean, are there 20 new nuclear plants being planned in the U.S. that we don't know about? Are the uranium being purchased offshore for Saudi Arabia and for China or Iran or other places? Is it such demand from the military, whether for use in outer space or on our military ships? So why uranium suddenly took off now, other than common sense that we really need more nuclear power, to create the energy we really need, here in North America and around the world. Other than that concept, why it suddenly exploded. So obviously there's demand for uranium, and the real question is, and I wish I had the answer, where specifically is it coming from? Because I know here in the U.S. there was only one new nuclear plant approved in Georgia in the last year or so. It takes about 10 years to get one approved and built. So where is the demand coming from? But it's moving up, so obviously something's going on, and you see it in the shares. Why should Cameco, which is the biggest name in uranium, suddenly go to new highs, 20-year highs, for example? So just follow the money. That's the best answer I can give you.
What's happening on the cryptocurrency front?
Doing well. Bitcoin's been upticking here a little bit. The Ethereum's been upticking here a little bit. And the big story is BlackRock and Larry Fink. We've talked about this before. BlackRock has applied to the Securities and Exchange Commission for an ETF for Bitcoin, and they're going to get it. They're just too big. They're the biggest money management firm on the planet. I mean, I don't know how much trillion of dollars that they manage, and they want an ETF for Bitcoin. So what happens when you have an ETF? If someone comes in and buys the ETF, you have to go out and buy the Bitcoin to back it up. And if you remember when the World Gold Council proposed GLD, the ETF for gold years ago, ever since that came into effect, gold's been overall trending higher. Of course, it's been volatile, but the demand is increased. So you got to be long Bitcoin. And I think the others go along with it. The whole industry, sort of trades alongside it. I mean, there's thousands of cryptos out there, so, I'm not saying they're all going to go up, but there are a few bigger names that should benefit. But I think if you have a core position in Bitcoin, whether you buy, an ETF or you go actually buy the Bitcoin, the fact that the big money, and I mean big money, BlackRock coming into that sphere, it's going higher. I mean, it may take 2 years, 3 years to double or triple your money, but it's going to happen if, you get accessibility like that. Most people just didn't know how to go about buying Bitcoin. Going to the various platforms on your phone, whether you have a wallet to store it and protect it. There's all this, strategy around owning a crypto that you have to learn about. But if you can just go buy it like a stock, like you can buy gold, it's a big bull, input, effect. So I'm bullish.
Anything big happening on the geocosmic front? Do we have new aliens visiting, or the same old ones?
Well, the aliens, in my view, have been here 8,000, 10,000 years. They're here anyway, and they're still here. But that's, nobody wants to talk about that. But just look at the Bible and see what's going on in the Bible. I mean, when Ezekiel got taken off, it was in a spaceship. It wasn't the angels. That's my opinion. But anyway, there's actually a book written about that anyway. Somebody read the account of Ezekiel, and they were a engineer, and I wish I could give you the name of the book, but you could probably search for it. And they used a biblical description, and they actually created a craft based on the description of the wheels within the wheels, and what the craft that Ezekiel saw, what it really looked like, using the thought that it was an extraterrestrial visit, not a spiritual one. So this is going to anger a lot of people, but there are different interpretations of what's in the Bible. But as far as the current geocosmic situation is concerned, forgetting the UFOs and the UAPs, the sun's magnetic poles are disappearing. And there's a report out of NASA. They're not too worried about it. They said the sun is about to lose its magnetic poles, and they say that the NASA Solar Dynamic Observatory revealed a weakening of the magnetic fields. This does happen on occasion, and it may not necessarily be bearish for the Earth, but it's just something they're monitoring. As far as just normal geocosmic activity, we had a full moon on September 29th, and what happened? The market bottomed 2 days later, and we had this little rally we're having now, so we keep an eye on the lunar cycles. The next lunar cycle to watch is on October 14th, which is the new moon. We just came out of the full moon, so we're watching stuff like that. And I can't find anything else dramatic happening on the planet other than we still know there's about 44 active volcanoes that the Smithsonian is reporting every day, and that's not good in terms of polluting the atmosphere and the effects of one of these things, really doing a Krakatoa type event. So we hope that doesn't happen, but we can't control that, and when it happens, it's God's will that civilization ends because of a super volcano like Yellowstone or one of these others. There's actually one in New Zealand that they say is closer to blowing than the Yellowstone one, but that could be 1,000 years from now too. But those are realities on our planet. We have a very dynamic planet, and there's been a lot of evidence about how civilization has been on this planet and got wiped out by such an event, whether it's an asteroid or a super volcanic activity or a polar shift. And, there's a lot of theories that we've had high civilization on this planet hundreds of thousands or millions of years ago that just got wiped out and we started all over again. So there is actually, excavations underway showing there was some type of technology way, way back, and this is unfortunate for mankind. Do we go through these million-year cycles where we rebuild ourselves after being destroyed because of some uncontrollable geocosmic event? And science is starting to build a case that could really have happened and could happen again. So, getting to Mars like Elon Musk is talking about, it's not such a bad idea, having an alternate place to go because the Earth may not be in the same, not as going to be destroyed, but, there could be some real tumultuous changes here in the, the decades or 1,000 years ahead for mankind. So it's a good plan to have, another base of operation if there's any sense that could be happening here on Earth. But anyway, we have to take a day at a time. We're more worried what the Federal Reserve's going to do and, whether they're going to build the wall, continue rebuilding the wall at the southern border. That's sort of the big discussion right now, and what's going to happen in the U.S. Congress. So we'll take it a day at a time and hope that you're working, hope that you're healthy, and we'll see what the market does.
Yeah, when it comes to walls, the Chinese built 5 big walls to keep the Mongolian hordes out. That didn't work thousands of years ago. I don't know if it's going to work now. You can go over them, around them, and under them.
Right. So it's a deterrent, but not a perfect answer. You're absolutely right. But that's a good analogy, Jim. I'm glad you brought that up. I mean, the story of having a wall and what's the Chinese wall, like 2,000 miles long, right? Something like that.
Well, it's a series of different walls. They don't actually lock up. But again, because the nearest fort where the soldiers were could be 50 miles away, you just have to breach it in one place, and they storm through. I've also seen reports where the current wall along the U.S.-Mexican border, people are cutting chunks out of it and selling it for scrap.
Oh, my goodness. Well, it shows there's a history of building walls, the fact that the Chinese did have one, and that's just something people should be reminded of, that we can't blame Donald Trump for wanting to build a wall. That's the first time in history, that's for sure.
Yeah, slows them down maybe, but doesn't stop.
That's right. So thank you for the interview. We'll talk next week, I guess.
Berlin Wall came down too.
You're right. Walls don't last forever. Good point.
Mark, thank you so much for being on This Week in Money.
Thanks for having me.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He was speaking to us from Arizona. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park and Mark Leibovit. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@HowStreet.com. Now stand by for a company showcase update from RecycLiCo CEO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija, Chief Executive Officer of RecycLiCo. Welcome back to Company Showcase.
Thanks for having me, Jim.
Zarko, what's the latest at RecycLiCo?
Well, I think there's a number of topics I wanted to really talk about during today's podcast. As many know, last week we were in Taiwan visiting with our JV partner, Zenith Chemical. And we visited over a number of days. One of the days we visited the future site of our JV plant in Taichung City, and it's also the existing site of Zenith Chemical's operations. And we really just dived in that day. We really dived into the details regarding plant layout, the location specifically, and how everything would be kind of positioned. Design, construction, commissioning, talk about permitting requirements as well, feedstock of material, offtake of the material, and a number of other topics as well, including expediting the setup of the joint venture itself. So therefore this week, as if you've seen our press release, we announced the signing of an amended and restated joint venture agreement for just that, right? Really to expedite the setup of the joint venture. Now, the amended agreement does not, as we mentioned in the press release as well, does not alter the economic substance of the original agreement announced in June, and we still keep the 50-50 joint venture ownership. So this is more just on I think this will definitely begin to speed things up. And as well following kind of regulatory requirements and both here in Canada and as well in Taiwan. Also, part of the trip together with Zenith, we met with a number of other firms, which I think we've identified a few potential opportunities in collaborators that I think we all feel confident about, but can't really talk about at this time. But it was just, having those discussions, reviewing on a technical note and on the business side of things, just was a lot more efficient while we were visiting there as well. And then the other topic, I guess, following our Taiwan trip, our team received the Environment and Business Award from the Surrey Board of Trade, which is a great accomplishment to receive among, all the great companies around us. So I just want to thank Teresa Piorn and Tony Mitchell from our team for receiving the award on behalf of the company. And then switching to another press release we had this week regarding patents, we announced that we secured 2 additional patents in Japan and Australia, and that was for our battery recycling technology. And this just continues essentially to bolster our patent portfolio and fortifies our commercial business model, which is the global deployment of our RecycLiCo technology, right? If we want to partner and JV with different strategics, having a strong patent portfolio is really key to us. And we've always emphasized our patents and our know-how to maintain a competitive edge in this growing market, which, I could say is recognized by many global companies and I think potential future JV prospects. So we really look at them on a global level, where our technology can be deployed and where we can support with that, with our team and our technology. I also got a lot of questions about the timing of the European patent, but I have to say that's not in my control. Every patent office is different in their review process and the period of time that takes. And our patent attorney will give us notice when we do get a reply, but that's similar to the Australian and Japanese one we got, right? This is, that's more of a notice that, it's been received, and we can go ahead and announce it. But other than that, they didn't have any indication of when that may have, when that would have been coming. And then, aside from switching topics from the patents, I also want to talk about from a few weeks back where we engaged with Oak Hill Financial for investor relations and capital markets advisory services. And this is to expand our shareholder base and amplify our reach, which I find is an opportune time right now. You're right. We have a great technology to share, and I think Oak Hill has been a great team to work with and continue working with in enhancing our market presence and identifying potential and existing investors, right? To just continue spreading that story. Recycling is, with a lot of the groups we talk to, recycling is a hot topic, and really showing how we differentiate from a technology side of things and from a business side of things is really key to explain and tell as many people as possible, really. Tell as many retail investors, institutional investors. That's really our focus here. And then finally, we also mentioned that that we'll be holding an annual and special meeting of shareholders on October 31st at 11 a.m. So the meeting will be at our office here in Surrey, BC, Canada. So all shareholders are invited, of course, to attend. So please let us know if you do plan on attending, and we'll make sure we can accommodate everybody. But yeah, Jim, there's a number of things definitely covered. Try to hit everything I was getting in questions and emails, and I saw on social channels. So I encourage everybody that is listening. If you do have any other questions, feel free to drop me a note by email, and I'll just try and compile all those questions and answer them in future podcasts as well.
Zarko, how can people email you, and where are you traded?
Yeah, so you can find pretty much all the information, email and anything company information on our website, www.RecycLiCo.com. And then as well, any information you need is there. And then as well, if you we are traded on the TSXV under the ticker symbol AMY, on the OTCQB under AMYZF, and on the Frankfurt Stock Exchange under ID4.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija. He's the Chief Executive Officer of RecycLiCo. I'm Jim Goddard. Our conversation took place on October 6th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.